Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
We could see subpar growth in the industrialized economies for many, many years because of what's going on here, because of the government's putting so much stimulus into the market and taxes going up and different types of things. We're not going to see the rebound in terms of credit that we did before. We're going to go into, I think, a very negative credit cycle, despite the fact that it looks like credit markets have stabilized. Heightened pain for the emerging markets. Emerging markets are really what's considered the periphery, and they're based on money flowing from the center, from the industrialized world economies out to the emerging markets for their performance, for their liquidity. Emerging markets are still highly dependent on international bank lending because they haven't developed their own capital markets. Deflation is the problem now, not inflation. We're seeing price levels fall in the major economies very fast and all across the board. People believe, unfortunately, that just the act of trying to increase the money supply is inflationary. In fact, it's not. If it was, we'd see inflation in Japan. Instead, in Japan, we've seen about 16 years of deflation, and it's getting worse. And here's really the risk bid scenario of really the driver of what we think could be the risk bid, meaning the U.S. Let me go back and again to show you chart-wise what we're talking about here. We're talking about this idea, and let me clear this idea that we could see the dollar in another one of these areas of risk bid right here, these big moves. Because if this green shoots area disappoints, we're looking for the dollar to make a big risk bid again. So that scenario comes from a real disappointment in this idea of green shoots. As you know, not everybody, but many people, based on the move in markets, have jumped on this idea. And if we see a disappointment and a rethink and back into a double-dip recession, not like we've gotten out of it before, but the reality that the globe hasn't rebounded, demand isn't there, it's going to be a scary thing, because it's going to be fool me once, shame on me, fool me twice, shame on you markets, and we think people would really capitulate and pull a lot of money out of risk asset classes. We think the trigger really has to be the idea of a China disappointment, meaning that although China has hit its 8% growth numbers, there's a lot of concern. One, that the numbers are false and fabricated by China. Two, the other real concern is, even if they're not fabricated, let's give China the benefit of the doubt and say that those numbers are real. China has put $1.7 trillion into its economy in the first half of the year through either direct bank lending or direct stimulus or bank lending. They control the banks and tell them how much and where to lend. The Central Committee basically does that. 1.7 trillion thrown into a 4 trillion economy, that's a bunch of liquidity. And it's gone into a lot of infrastructure development, a lot of real estate development, and it's gone into a lot of state-owned industries. And a lot of it has been used to prop up the stock market, because most stocks are government-owned in China, so it increases the wealth of the Central Committee once again. And those tightly connected politically to the Central Committee benefit from that. It hasn't gone into an effort to really make the transition from an export economy to the domestic economy. So China is really banking on a rebound in global demand here, assuming this money has gone into infrastructure and increased in terms of the ability to China produce more and more goods. The interesting thing is Chinese companies were already running on very wafer-thin margins, and this idea that increasing capacity in an environment where you haven't seen global demand rebound is a very, very risky scenario. So that's really the concern, or at least the area where China could disappoint. as I said. And if that's the case, I think we'd see really a whole lot of capitulation back out of the emerging markets. Those stock markets are up 60, 70, 80% since the green shoots move. That's a powerful move. If China disappoints, you can bet that those people that are up 50, 60, 70% are going to pull that money off the table very, very fast. You're going to see people run for the exits very, very fast. And when they run for the exits, if there's big pools of capital, again, they're going to hide in the U.S. Treasury market. That is the only deep enough market to take these pools of capital, and that drives the risk bid. In terms of Europe, what's interesting is Europe is so tightly connected to these emerging markets. It's incredible. The Eurozone banking system, the lending to emerging market relative to the U.S. banking system is tremendous. 3.7 trillion at the end of 2008, 3.7 trillion in Eurozone bank lending to the emerging markets, whereas the U.S. banking system lent about 625 billion. So you can see the exposure the European banking system has to the emerging markets, primarily across Eastern and Central Europe, but also elsewhere. So if we do see this disappointment and we do see capitulation back out of emerging markets, we think it hits the euro pretty hard as it flows into the banking system. So if we do see the risk bid, and again, this is one of the scenarios, and it's actually really a scenario we've been trading off of and getting hit because of it, because it hasn't played out yet. But from a fundamental standpoint, we're still very open to this, and I'd have to say it's our lead scenario, even though we've been lightening up a bit. If that happens, the Australian dollar, Canadian dollar, the commodity currencies will get the hardest. Remember, as I said, and I showed you on the chart, the Australian dollar is the key risk appetite currency. It goes up very, very fast in risk appetite, and also it implodes very, very fast on this ebb and flow of risk appetite to risk aversion. So Steve will show you ways to play those. As I said, the euro can tank in a very, very big way if the emerging markets get hit. And we could possibly see the yen rally because of the fact that the yen plays the role as a risk aversion currency. The yen is starting to play the safe haven role for Asia, in that if a hot money comes out of China, that doesn't want to go into the U.S. and is very afraid to go into the U.S. dollar, the yen tends to get a lot of that flow because of just again, Japanese government bond market's pretty deep, and the Japanese yen is in plenty of supply, and there's big liquidity there. So again, here's the charts again, just showing you how the euro and the Australian dollar, euro is blue, Australian dollar is red, and how the U.S. dollar in black, how they've moved, obviously counter to the U.S. dollar, as they should. If we get a risk bid, we're going to see these guys come back, and we're going to see the U.S. dollar rally again in a very big way. Again, what we think you should watch is China. If China doesn't, if China disappoints, it could be trouble.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.